Welcome to Manifested Publishers e-learning portal. In our today's session, we are continuing with the revision of Management Accounting April 2022 sitting, and today we will look at question number 5. So ensure you have the paper with you, have your calculator, and follow me closely. Question number 5, part A. Smart Products Limited operates standard costing and budgetary control system. The following information, the following is the company's standard cost card. So in that standard cost card, we have direct materials, direct labor, we have variable overheads, fixed overheads, standard cost per unit, standard profit per unit, standard sale price per unit, which is given in that table. Additional information, note number 1. Each unit requires 3 kilograms of material, which costs 40 shillings per kilogram and 45 minutes of direct labor at a rate of 80 shillings per hour. Note number 2. Variable overheads are covered on direct labor hour basis. Roman number 3. Fixed overheads are absorbed on annual production budget of 180,000 units. Roman number 3. Fixed overheads are absorbed, number 4, for the year to 31st March 2022, 120,000 units have been manufactured and sold. Contrary to the management's expectation, the company's profit and loss statement reflected a loss of 1,380,000 instead of an expected profit of 3,600,000 as provided below. So we have a statement which is showing a loss of 1,380,000. Then required Roman number 1, budgeted profit and loss account for the year ended 31st March 2022. Roman number 2, flexible budget for the production achieved. We want to begin with the Roman number 1. This is question number 5. We begin with the Roman 1. So we are required to prepare a budgeted profit and loss account. So the question is from marginal and absorption costing topic. So we need to know application of marginal and absorption costing. So the question is strictly on marginal costing, and therefore we need to know how the profit statement is prepared under marginal costing. So following the formats, we are preparing the budgeted profit. Budgeted profit, we need to begin, we have 2 columns. We begin with the sales. How do we calculate sales? In note number 3, we are told that fixed overhead are absorbed on annual production budget of 180,000 units. So the budgeted units were 180,000 and the selling price is 250. So to get the sales, we can reduce this in thousands. We have 120 shillings. Not 120, 250 shillings multiplied by 180 units. So this will give us 45. It will give us 45,000. 45,000. Then from there we less cost of sales. So the cost of sales constitutes, in this case, we do not have either opening or closing, so we simply have production costs. We show the production costs, and we say that in marginal or absorption, in marginal costing, only variable costs will comprise or will be related to the cost of sales. But if we have to use absorption costing, then we will need both fixed and variable. So we have not been directed which method we are to use. So based on the style cost we've been provided, the style cost card, we have both the fixed production and the variable. So we can use the absorption costing method. So in this case, we will have direct materials. And the direct materials, in note number 1, we are told that each unit requires 3 kilograms of material which cost 40 shillings per kilogram. And then 180 units were produced. So how do you calculate the amount for materials? We are taking the number of units produced, we multiply by, and have separate kilos, please. 1 kilos. Direct materials. We have 180,000 units. You multiply that. We are told that it requires 3 kilograms. So to produce 1 unit of this product, we require 3 kilograms. And the cost per kilogram is 40. So when we multiply this, it will give us the cost for that. So we have 180,000, 80 times 3 times 40, which will give us 21,600. This was 45,000. Then we move to direct labor. This is working number 1. Working 2, direct labor. We are told in the same note number 1 that and 45 minutes direct labor at a rate of 80. So again, 180,000 units were produced. Multiplied by 45 minutes are used to produce 1 minute. So what about 180? We are taking 45 minutes over 16. Convert the minute to hours. Multiply by the rate per hour. We are told that of direct labor at a rate of 20 shillings per hour. So we multiply by 80. This will give us 10,800. We have direct, we have variable overheads. Variable overheads, note number 2, we are told that variable overheads are recovered on direct labor hour basis. So again, we need to calculate the variable overheads. And variable overheads are covered on the basis of direct labor. So we have to take 180 units multiplied by, in fact, we already calculated that. So we simply need to calculate it on labor. In that table, the variable costs had 20 shillings. So we express it in labor, which had 60 shillings. Then we multiply by 10,800. that will give you the variable cost, which is absorbed on labor. This is 3,600. We also have fixed overheads. This will be working number 4, fixed overheads. We are told that fixed overheads of 30. So the amount of the standard cost was 30. So take 180 units multiplied by 30 kills. And this will be 180 times 30, which is 5,400. We now get the total of that. This will give us 41,400. So this gives gross profit of 3,600. So since there were, is it 4,000, 41,000? 45,000 minus 41,400. Yes, it gives us 3,600. So since there are no expenses, the gross or the budgeted profit for this company will be 3,600. That's the number 1 of that question. Then number 2, we are told that flexible budget for the production achieved. So how do we prepare a flexible budget? In note number 4, we are told that for the year to 31st March 2022, 120,000 units have been manufactured and sold. And flexible budget is prepared when we have a variance, like we had a budget for production of 180,000 units. But now, we are told that for the year to 31st March 2022, 120,000 units have been manufactured, which is bringing about a variance of around 60,000. So what will be the variation in profit? So what we are preparing is simply to show the variation in. So the flexible budget will be as follows. Show the sales. And how are we calculating sales? These are working number 5. How do we calculate the sales? Production in this case is 120,000. So we have 120,000 units. We multiply by the standard sale price of 250. This will give us 30,000. So our sales, which is working number 5, is 30,000. Then we less the cost of sales. So under the cost of sales, we have production costs, which are including direct materials. So how will you calculate direct materials? Note number 6 of that same question. We are told in note number 1 that each unit requires 3 kilograms of the material at a cost of 40. So for us to calculate direct materials, we now take 120 units times 3 kilograms times 40. And this will give us 14,400 shillings. We also have direct labor. This is working number 6. Working number 6. This will be working number 7. Direct labor. We are told that and 45 minutes of direct labor at a rate of 80 shillings per hour. And so we have 120 units that were produced, and 45 minutes are used to produce 1 unit. What about 120? So convert this to 2 hours by dividing by 60 multiplied by the cost per hour, which is 80. This will give us 7,200. Then we calculate variable overheads, which are absorbed on the basis of direct labor hours. So for this we are given 20, so we have 20 divided by 60 times the amount for direct labor, which is 7,200. This will give, this is variable overheads, working number 8. The amount is 2,400. Then we again show the fixed costs. Fixed overheads, which will be working number 9. Fixed overheads. This will simply be 20,000 units. We multiply by the cost per unit, which is 30. And this will give us 3,600. Again, we get the total. And the total is 27,600. We subtract, we get the gross profit. The gross profit of 2,400, which is the variance. So that is Roman 2 of that question. Is a Roman 2 of that. And sorry, I have a correction. Fixed cost remains constant. So fixed cost will be calculated on 180 units, not 120. It will be calculated on 120 because it is assumed to remain constant. So it should be 180 times 30, which will give us 5,400, not 3,000. 5,400. We get the totals. This should be 29,400. 29,400. So the variance will be 600, not 2,400. That's the variance. So that was part A of question number 5. We proceed on to question number 5, part B. Part B of question number 5. We are told that Yasir Limited produces 10,000 units per annum by employing 50% of the total factory capacity. The selling price per unit is 500, and the total costs are as follows. So we've been given the total costs for materials, wages, fixed overheads, and then we have additional information. Note number 1, variable overheads maintains a constant ratio to the number of units produced. Note number 2, the production manager is evaluating acceptance of a special offer of additional 10,000 units at a selling price of 385.5 each. Note number 3, the increased volume of purchases will reduce the material price by 2.5%. Note number 4, the wage rates will remain constant, but due to employment of new workers, there will be a drop in labor efficiency by 5% on oil production. Required, Roma number 1, prepare a statement showing the variation of net profits resulting from the acceptance of the order. Then Roman 2, advise the management of Yasiri Limited on whether to accept the offer. Can we see this, please? So the question is from marginal application of marginal costing, where we have short-run decisions. And this decision is acceptance or rejection of offer. So how do we apply acceptance or rejection of an offer? It normally arises where a firm has a capacity or a facility which is being underutilized. And when this facility is being underutilized, it means you have a portion which can be utilized by an outside either supplier or can be an outside customer. So when such happens, the firm is faced with either accepting the offer which comes in to use that spare capacity or to reject it. And so to make a decision on this decision, we need to understand what is the current position of the firm and what are the fixed costs and their implication when this new customer comes. So we normally assume that fixed costs will remain constant from 0 capacity to 100%. But when this customer comes, will it change the profitability of the firm or not? And so to make this decision, we will be as follows. We need to prepare the profit statement. And when we are preparing the profit statement, we will exclude the fixed costs. Why? We say that they remain constant. Whether that customer comes in or not, the firm will still incur those costs, so we will exclude them. And our intention will simply be to get the contribution. So according to the question, we are told that the firm is producing at 10,000 units, which is representing 50% capacity. So we need to calculate the profitability of the firm at 50% capacity, which is representing 10,000 units. And we are also told that the firm, the production manager is evaluating acceptance of a special offer of additional. So when we have additional 10,000, it means that we have an additional capacity to 20, and that will represent 100% capacity. And the units will be 20,000. We already have 10. Increasing by 10 units, the units will be 20, and that will be 100% capacity. And we will also need to show the variance according to the question. We need to show the variance. We are told to prepare a statement showing the variation of net profits resulting from the acceptance of the order. So we are beginning with the sales. Remember, we are showing the profit. So we begin with sales. The sales under 10,000 units, we are told that the selling price per unit is 500. So this is working with one sales. We have 50% capacity and 100%. So we are told that the selling price is 500 shillings and that 50 capacity the units are 10,000. So take 10,000 multiplied by 500. What will you get? We can reduce this by thousands. So of 10,000 multiplied by 500, this will give us 5 million. 5 million. You think 5 million is what? Can still have it. Do you use 5 million? So at 50%, the sales will be 5 million, and at 100%, 100% is where we have additional 10,000. So we already have 5 million represented by 10,000, then plus the other 10,000 will be 10,000 multiplied by the selling price. We are told that the selling price will be 387.5, which will give us 3,875,000. So when we add this, we will have 8 million sales. You simply write 8,875,000. And then what is the variance? We get the variance. The variance will be 8,875,000 minus 5,000. This is 3,875,000. That's the variance. Then we proceed on to variable costs. According to the table given, for the variable cost, under that we have direct materials. So this will be note number 2, direct materials. Working number 2. So we are told that direct materials are at 1 million. So for at 50% it is already given at 1 million, just write 1 million. And then at 100%, we need to calculate under note number 3. We are told that the increased volume of purchases will reduce the material price by 2.5%. We will reduce the price by 2.5. So we will reduce the price by 2.5 from 100. We remain with 97.5. So if 1 million, we are at 100%. 1 million is representing 10,000 plus another 1 million representing the other 10,000. Meaning we will have a total of 2 million. But now these 2 million will be affected where the price will now reduce. So this will equal to 2 million. And we multiply this by 0.975. That's 100 minus 2.5%. So the price will reduce by that. And we will calculate that. the amount will be 1,950,000. So this will be the amount. Then we get the variance, which is 950,000. We move on to direct labor. And direct labor, that is working on number 3. At 50%, we will already be given the direct labor represented by wages of 2 million. So we already have 2 million. But we need to calculate for 100 or at 100 capacity. So at 100 capacity, we have double that. If 2 million is representing 10,000, then 2 million plus 2 million, or 2 million times 2 will represent the 100 capacity, which will be 4 million. But note number 4. We are told that the wage rates will remain constant, but due to employment of new workers, there will be a drop in labor efficiency by 5% on oil production. So this 4 million will represent 5%, will represent 95%. Then what about 100? So if 4 million is representing 95%, then we are to calculate it at, it is just the same as if 4 million, can we see 100 is, so if 95% equals this, what about 1? What about 1? What about 100? If 95% is representing that, then what about 100? Should 100 over 90, not should 100 over 95. This will be 100 multiplied by 95, then we find not 97 divided by 95. And so when you calculate this, we have 4 million I get 4,210,000. 4,210,526. From there, get the variance. The balance will be 2,210,526. So we normally have sales less variable costs. So we now subtract this to get, or to show what we refer to as contribution, to show the contribution. So we have 5 million minus 1 million minus 2 million, which will give us will be 2 million. Then at 100% capacity, subtract the marginal and variable costs. And this will give us 27 or 2,715,474. Then lastly, we'll show the variance. And the variance will be 714,474. So the question was, Prepare a statement showing the variation of net profits resulting from the acceptance of the order. So what is the variation? The variation of the profit is 714,474. Why have we left out the fixed costs? The fixed costs have been ignored. Why? Because they have already been taken care of at 50% capacity. So when we are looking at, when we want to advise the farm, our intention is what is the effect of the 100% capacity on 50%. So we have a contribution of already 2 million, and then a contribution of this, it means that when a new order is accepted, it will contribute 2,715,470, which is increasing the existing contribution by 474. So in the number 2, we are now to advise the farm, advise the management of a Siri Limited on whether to accept the offer or not. So what do we say? We say that the company should accept the offer. Why? Because accepting the offer will increase the current contribution by 714,474. So that is the advice we can give. And we can say, in this case, the fixed costs are irrelevant since they have been taken care of at 50% capacity. So just to make a summary, whenever we are given a question on acceptance or rejection of an offer, we are looking at what is the current capacity of the farm. So always show the position of the farm at the current position for a case of 50%, and what is the new position? It will move this farm to 100%. So when that happens, then what will be the contribution? So to calculate the contribution, we exclude all the fixed costs. Why? We assume they are already taken care of under the current position. And that was how we are to go about question number 5. We've come to the end of our session. Bye bye until the next session.